I'm Marc Treviño. With me this morning is Melissa Sawyer, who co-heads the corporate governance group here with me, and our colleague, Jun Yu, who has been working in this area since joining Sullivan Cromwell. The session is for you. It has always been interactive. If you have any questions at this point, given that we've entered the 21st century on technology, please use the question feature. We'll be monitoring it, and we'll do our best to respond in real time. As always, we'll look in some detail at what happened earlier this year and just discuss the implications for next spring. We recognize that this is the season to discuss the proxy season, so there's going to be a number of these. We intend for this one to be an overview, so there are some topics that we're going to cruise over. There's more detail in our written proxy season review, which is available in multiple parts on our website. And if you just want more detail, obviously just ask as part of this. As we turn to slide 2 here, we can look at the agenda for this morning. So looking at this, when I said that Melissa and June were with me, I should have, of course, said virtually with me, which is going to be our first topic today. After that, we're going to review 14A8 shareholder proposals, say on pay and no action requests. We may not get to all of our agenda, but we will save time at the end to discuss considerations related to compensation decisions that issuers are going to be facing at year end and the say on pay implications for 2021. On slide 3, there are also some developments that happened after the 2020 season that we definitely should discuss. Some of you may be joining us directly from the SEC's meeting this morning. We had scheduled this meeting, our webinar actually, around the fact that the SEC was supposed to be considering 14A8 modernization last Tuesday, or Wednesday. But now they're in the middle of doing it right now. They haven't gotten to it yet. I think it's going to be starting momentarily, so hopefully we can post you real time if the fact sheet comes out or we get some updates from our colleagues. The SEC has been busy. A little less than a month ago, they adopted human capital disclosure, which is going to be effective for the coming 10K season. It got a lot of attention as part of this release. It continues private ordering, and so it does not adopt any particular reporting framework, but we'll discuss about that in the 14A8 context, but it does not adopt SASB, ISO, or anything like that. Instead, it just requires a principle-based approach and stresses the need for every issuer to make disclosures specific to it. In that regard, the chairman did say that he expects to see meaningful qualitative and quantitative disclosure, and I would expect that this administration and any future administration would be interested in it. But there's also a note in his speech that he expects that there'll be non-GAAP financial measures, and he would expect those measures to be consistent over time. And so as you think about your ESG disclosure, which likely hasn't been subject to the same disclosure regime as your 10K disclosure has been, you want to think about connecting those two, particularly for this season, because you wouldn't want two different sets of metrics out there to describe the same things. We, the first-time issuers, have to think about that and to coordinate the 10K team with the proxy team. We obviously have seen proxy advisor and voting reform. This administration in particular is deeply dubious of the disconnect between the decision to purchase and hold securities and the decision to vote them. And they have adopted all kinds of proposals or regulations to try to connect those two that include proxy advisor reform, which will not be effective for this season. It includes the recent Department of Labor proposal with respect to clarifying the voting obligations of ERISA fiduciaries so that so that investors are not required to vote. And suggesting that they only vote if it's efficient for them as a holder's perspective. Again, this is just designed to connect the decision to invest and hold with the decision to vote, and is also sort of stands against the tide on stakeholder and ESG type factors, whether that if there's a regime change, those principles continue. We'll have to see the next season. I have to mention the proposed change to Schedule 13F, particularly for smaller issuers. This could limit insight into your shareholder base, which obviously is consistent with the goals of engagement, and would place even greater engagement focus on the very, very large institutional investors. So there's a comment process for that. I think there's been a number of comments, and you should think about that. This is outside of the regulatory sphere. There have been significant developments in the area of diversity and inclusion. We know, I'm sure all of you have received ISS's letter requesting that you disclose your director's self-identified race and ethnicity data, as well as the data of your NEOs. State Street has requested disclosure regarding the role of diversity in human capital, the description of progress against those goals, metrics, and is going to be a function with a shout out to the EEO1 framework. Again, you should expect that in this engagement season, and we'll talk about what it means for shareholder proposals. The flip side of that is you've also seen private litigants move in this area, and at this point, let me see how many we have. I think we have 5 lawsuits in this area. The most recent one I'm aware of was just earlier this month with respect to Gap, the company. With respect to the difference between statements around the value of diversity for the company and the representation on the board. And so those lawsuits were framed as derivative actions and have been moving forward. And I expect that they're mostly going to be around shaming companies that they were sued in this area, as opposed to the success of the litigation. But obviously, it's something that you should keep an eye out for yourselves and for your boards. So that's it for our roadmap and our late thoughts. So maybe we'll move on.
So I'm going to start with a discussion about virtual meetings, which dogged us all this spring, largely because the shutdowns from the pandemic occurred right in the middle of the proxy season. And for many issuers, those shutdowns started to roll through after the issuers had already mailed their proxy statements for their 2020 annual meetings. So I think first I want to touch on what we saw in 2020, and then I want to talk a little bit about what we might see in 2021. 2020 was a mad scramble. People who were dealing with scheduling the shareholder meeting in the spring had to evaluate on the fly both the state law implications of whether they could switch to a virtual meeting in an environment where large gatherings of people were being discouraged, if not banned entirely. And for some Delaware corporations, the answer was a little bit more straightforward, but that wasn't the case in every state. So, for example, in New York corporations had to rely to some extent on executive orders that had rolling expiration dates to determine whether they were permitted to have virtual meetings instead of in-person shareholder meetings. In-house teams also had to take a look at their bylaws, not to mention deal with the logistics of securing a virtual meeting platform that was available on their preferred date for hosting their meeting. And surprisingly, there were a number of virtual meeting providers who claimed to be at capacity in terms of their ability to host these meetings, not because the technology wasn't available, but because they didn't have sufficient staffing to manage more than a few of these meetings on any given day. The issues that we saw were exacerbated for contested meetings because really before 2020, we had not seen a contested meeting take place in a virtual platform. And so there were a number of issues that had to be worked through for contested meetings. The proxy advisors and institutional investors actually did their best to show flexibility for issuers to be able to convert to virtual meetings. They put out statements indicating that they would be flexible and not apply their usual policies that were sort of in opposition to holding wholly virtual meetings in this context. And as a result, what we saw in the first half of 2020 was that almost 75% of shareholder meetings for the S&P 1500 composite were held virtually. So I think the question really is, what are people going to do in 2021? And I think it's just really hard to answer that question at this stage because it is likely to be informed by facts on the ground and what's happening with the pandemic and whether there continue to be shelter-in-place orders or restrictions on large gatherings at that time. Very few companies have come out at this point to state whether they intend to hold virtual or hybrid meetings. Hybrids were not common in the spring of 2020. It's hard to know whether they'll become more common going forward. It's also hard to know at this point how the proxy advisors and institutional investors will shape their policies in light of their learnings in the 2020 experience. For example, a number of institutional shareholders expressed concerns around the format of the virtual meetings they attended. While they were happy with the ease at which they were able to attend meetings from their desktops, I think some were frustrated by the way in which issuers curated the Q&A portions of the meetings and have pushed subsequently for more free-flowing Q&A discussions to occur live during the meeting, or at least requested that issuers post all questions that they receive with responses on their website following the meeting. Some institutional investors also expressed concerns at the format in which shareholder proponents were permitted to present their proposals at the meetings, whether they were pre-recorded presentations or whether they were permitted to present live. And moreover, a few institutional investors also indicated a strong preference for having video formats for these meetings rather than just audio formats. So I think all of those are questions that issuers will need to think through if we end up in a situation where people are having virtual meetings again to the same extent in 2021. I think issuers will also continue to need to work through some of the same technical issues that we saw in 2020, whether it's managing cybersecurity issues associated with the meetings or simple technical snafus. We had a number of situations where the meetings were interrupted by audio failures, for example, and that raised difficult questions for the issuer about whether the meeting could continue as originally scheduled, just for example. So I think there's still much work to be done on this. And as we sit here at the end of September, I think it's too soon to tell what this is going to look like exactly in 2021, but we've certainly learned a lot from the 2020 experience. So with that, I'll turn it over to June.
Melissa, we had one question on the fly, which was whether we could comment on any contested meetings of which we were aware. I'm aware of the one. Was it Tegna?
Tegna, yeah. Yeah, my understanding is that the proxy solicitors and the virtual meeting platform provider spent quite a lot of time in that scenario working through the logistics of how to handle the contested meeting. And there's quite a lot of debate about the intersection between contested virtual meetings and the potential for universal proxies or universal ballots, for example. I think that much of that is still undecided.
And then, as we go over to June, I think just corporate secretaries out there should expect there to be more investor demands with respect to how these annual meetings are conducted this year. And they should just be ready for that as part of ISS's policy review. We've heard lots of at least smaller investors get together and talk about this. So it's not going to be the same.
Okay, so I just want to give an overview of the research we did this year in order to generate our presentation as well as our longer written memos, we've looked at, for the last couple of years, the trends not only in the number of shareholder proposals that went to a vote or eventually gained over 50% of shareholder votes, which we call passing. We also have been observing for the last several years the trends in the number of proposals that were submitted. And we gathered that data from ISS. Over the last several years, we've seen a consistent decline in the number of proposals submitted year over year. In particular, in 2017 and 2018, when we saw a very high number of environmental, social, and political proposals being submitted, we're seeing that those numbers come down. And the decline, as you can see from the graph on the screen, in the ESP space has been the most dramatic over the last 4 years, with the governance proposals declining by a smaller portion year over year, and compensation proposals, which have been traditionally low, staying fairly consistent over the last few years. And one thing we want to note this year in particular that somewhat contributed to the decline in ESP proposals was a drop in the so-called anti-ESP proposals, or proposals that were against investing or managing on the basis of ESP factors. And those, are the proposals from entities such as Burn More Coal or the National Center for Public Policy Research, which I think Marc and Melissa will talk about when we get into the specific trends that we saw this year in the shareholder proposals. Next slide, please. So even though there was a decline in the total number of submissions on ESP, it continued to outstrip the other categories, and it has done so for 4 years, since ESP has been a focal point. And you can see in the graph, one of the reasons we think looking at submission data makes this story more comprehensive is that the number of voted proposals, the change year over year is not really significant. You really see how the distribution of shareholder proposals among the different categories shift when you look at proposals submitted. And one thing we wanted to note in particular this year was the number of passing shareholder proposals. Again, those are proposals that received over 50% of votes cast. You can see that although the number of submitted proposals have gone down in the ESP category, this year we reached a record number of 15 in the first half of 2020 that did receive over 50% of the votes cast. And that's kind of in contrast with what you're seeing in the governance space, where a much lower number of proposals did pass this year on matters of structural and board composition governance. Next slide. And so before turning it over for a discussion of the particular hot topics, I just wanted to give an overview of what we saw in ESP overall. Last year was the year of political contribution proposals. It's the first year that we've seen where the ESP proposals that were submitted were, a plurality of those were in the category of political contribution, especially dark money contribution, affiliations with trade organizations, etc. This year, we had a flip again where environmental proposals predominated, and that went back to the trends in 2016, 2017, and 2018, especially in 17 and 18 after the U.S. exited the Paris Agreement, and shareholders were submitting a number of proposals asking companies to voluntarily adopt those disclosure standards. Contributing also to the environmental proposals is something Melissa will talk about soon, which is the ESG standardized disclosure request that came up this year. And as I said earlier, a number of shareholder proposals on ESG passed, including several political proposals and another hot topic that was in focus for the last couple of years on human capital management.
Melissa, before we go to you, we had one quick question. Never mind. Well, I'll answer for other folks, which was, what is ESP versus ESG? In this context, when we're talking about shareholder proposals and such, governance is really its own animal. And so we separate governance out as sort of the historic original, the historic OG of shareholder proposals, and view environmental, social, and political proposals separately, and we call those ESP.
Okay, so both Marc and June have alluded to ESG disclosure frameworks, so I'll just spend 1 minute on those. The bottom line is that for U.S. issuers, the SEC has not adopted a specific ESG disclosure framework. In fact, they've said that they think that issuers should use the same principles-based approach to ESG issues that they use for other types of disclosures. The benefit of that is that the disclosures tend to be more customized and reflect management's and the board's view about what is material to and important for an issuer. The downside from an investor perspective is that it leads to less standardization across issuers. Even within the same industry, they may be using different metrics or not disclosing to any set of metrics within particular subject matters at all. So a number of institutional investors, notwithstanding the SEC's position, have come out in favor of the adoption of more standardized disclosure frameworks for ESG. For example, BlackRock, State Street, and Vanguard have all put out statements advocating really for use of SASB and TCFD frameworks. These calls for use of standardized frameworks have also come from some of the traditional ESP types of proponents. So, for example, As You Sow, which is a well-known shareholder proponent, has made a number of proposals in the last year for issuers to start using SASB as a basis for their disclosures on ESG issues. And the good thing, I suppose, about As You Sow is that in a number of cases, they've been willing to withdraw those proposals when issuers have agreed to introduce some of those standards into their disclosures. So
we had one note from the audience, which is that the big four accounting firms have come out with a statement, which is all I've seen so far, that they're trying to align on a unified ESG disclosure framework. I'm not exactly sure what that means for issuers at this point. Melissa and June, I don't know if you have any more detail on that at this point.
No, I don't.
Anyway, sorry for the interruption.
Okay, so with that sort of overlay about standardized disclosure frameworks, I think a lot of the shareholder proposals requesting additional disclosure or creation of reports for boards or similar types of things have come in for issuers in the last year. And one category of that is environmental proposals. We saw quite a few of those in 2020, and a lot of them went to a vote. We actually even saw 4 of them pass in the last year with increasing shareholder support that seems largely driven by ISS support for those proposals. And some of the movement in the numbers ties back to a point that June made, which is that we did see a decline in those anti-ESP proposals. So ISS usually opposed anti-ESP proposals because there were fewer of those. The average impact of ISS support seemed to go up. And the story is similar for political proposals, where they continue to represent a large portion of the total proposals that we're seeing, even though new submissions declined a little bit relative to 2019. A lot of them are going to a vote. It's hard to get these kicked out by seeking no action relief, and it's hard to get them withdrawn unless you concede to make the exact disclosures that the proposal is requesting. And some of these have actually passed, and a lot of issuers are seeing the approval rates creep up for these proposals. Most of these proposals are just requesting enhanced disclosure around where the issuer's political contribution dollars are going, whether it's to political candidates or to trade organizations or nonprofits, lobbying, and other sources like that. There were a couple of outliers that seemed more specific to particular issuers. The one thing that we didn't see, which we thought we might after 2019, was we did not see a surge of shareholder proposals asking for shareholder advisory votes on political contributions. That did not come up in 2020 the way that we had expected. What was consistent with prior years, though, was that ISS continued to support political contribution proposals at a very, very high rate. So with that, I'll let Marc talk about human capital.
I have so much to talk about and want to even be human capital. So we're going to do our live blog on the SEC meeting for those who want to get ahead of it. So they are adopting 1488 reform. They are going with the three hurdles that they had proposed, which is keeping the $2,000 threshold, but requiring a 3-year holding period and adding a $15,000 threshold for 2 years and $25,000 for 1 year. In what I venture to say is bad news for most of the folks listening on this call, they have grandfathered 2,000 for anyone who's held 2,000 for 1 year. So that if you held 2,000 for 1 year and you keep holding it, then you are grandfathered and can continue to make shareholder proposals in a world where 30% of shareholders, the 30% of shareholder proposals are by 3 individuals, and only 6% or so pass every year. It's a change. It'll be interesting to see how much of a change it is. The resubmission thresholds have been increased to 5% after the first submission, 15% after the second submission, and 25% after the third submission, which should be meaningful for issuers who receive the same shareholder proposal multiple times. The rule prohibits aggregation among holders. It continues to limit, or as proposed, it limits multiple proposals by the same person, including now representatives. So you can't have a shareholder proposal by one shareholder and then another one by a representative, and have the representative represent both, which is meaningful in this individual context. And there is the requirement for, I believe, for proponents to make themselves available to engage for some period. I think it's 10 and 30 to discuss the proposal and the company's response. So those are the hot topics on what's going on at the SEC right now. If we get more on our live blog, we will share it with you so that you can be first informed. We're going to turn to human capital. We did get one question, which is, what is this going to look like on human capital disclosure for the 10K? And when is it? And the answer is, if you're a calendar filer, it's for this year's 10K. So it's here. What does it look like? We don't really know to a certain extent because it is principle based, and they try to keep from pushing you into any particular spot. There is an example in the release that says, look, by way of example, if the number of this is tagged to the requirement that you identify your total number of employees. And so the example is, look, if the number of part-time employees, full-time employees, independent contractors, and contingent workers are material to understanding your business, and you can imagine a business where that might be material, then you need to disclose that. And so that is one example that comes from the release. I think like MD&A generally, another look would be what types of reports on human capital does management receive? Would be another way to think about the types of things that might be meaningful in this. But let's turn now back to our regularly scheduled program, for those of you who are 30 or older. With respect to human capital management proposals, these proposals really started in 2018. The level of support for them has been pretty steady at 25%, which is meaningful. The pass rate of 5 is a first time, and it's very, very difficult to predict how current events feed into shareholder proposals. There is a lag and a filter, and you just don't really know how that's going to connect. But I venture to say that companies will feel the need to be more responsive to proposals in this area in light of the pandemic and Black Lives Matter, just the same way as we saw the need to be more sensitive to these proposals and the connection with Me Too 2 years ago. So workplace diversity increased substantially relative to 2019. They were predominantly sponsored by Trillium. This year, about a third reached a vote, which is different from last year, which was 2/3. The majority of these requested implementation of a diversity report for policies at the general workplace level. Only 2 were at the management level. I might expect to see that change this year. There was a subcategory of proposals that wanted policies to prohibit discrimination based on gender identity and sexual orientation. There were 6 of those. Again, they were all Trillium proposals. Shareholder support was fairly high for each of these proposals. There's noise in the total number because there are some anti-workplace diversity proposals in there, which 3 of which were voted at Netflix, Starbucks, and Twitter, and they received what you might expect, which is like a 1% vote, give or take. And so they hold down this number. If you were to exclude those, you're looking at shareholder support of 45%, which is very, very high. And again, I would expect that this year, if you receive this proposal, it would be higher. The 3 that passed seem to be a bit unique, so I don't know that we would take anything from that, but I do think that this is an area where I would expect activity and successful activity for the next season. The next category of human capital proposal is gender racial pay gap, which is on slide 16. And these dropped significantly from the prior year, and shareholder support also declined meaningfully. I don't know whether the focus has changed on that. Perhaps Citigroup last year became the first U.S. company to disclose the global unadjusted pay gap. It was joined by Starbucks and MasterCard. Those are the only two that Arjuna noted. They were the ones that submitted all the proposals this year. Those were the only companies that got an A grade on gender pay from Arjuna as well. And I think the final sort of category that we want to highlight of human capital is arbitration of employee claims. And in that case, we saw this. We saw it meaningfully in 2019. We saw it again in 2020. A number were excluded through the no action process. A number were withdrawn. Of the two that came to a vote, Chipotle's passed, but I think Chipotle was also going through other issues at the time. And the one at Alphabet received meaningful support as a second proposal. Notably, would be higher than the threshold the SEC is just adopting at this point. Separately, we should also discuss social capital proposals. They became more prevalent this year they became prevalent this year in the sense that other than human rights, we really saw for the first time corporate purpose proposals and other social capital proposals stemming really, I think, from the Business Roundtable statement on purpose, which we've all discussed a fair amount. Some signatories received proposals suggesting that they're not meeting their pledge and that they should change their governance documents to accommodate that. Those proposals received relatively low support. I don't know whether these proposals in their current form, you're going to see more of them. I think there's going to be more specific proposals around the pandemic that you'll be seeing in the coming season, but we'll have to see. With that, unless there's some questions I missed, I'm going to turn this back over to, I think, Melissa is going to talk about the merging of ESP and governance proposals.
Yeah, before I do that, maybe June, do you want to read the CLE code for our participants? And I'm just going to say that again. We're going to read the CLE code now so everybody can get their pens ready.
Yeah, so the CLE code for this session is 981235. Again, 981235. And we'll just remind everyone at the end of the hour of the code again in case anyone missed it.
Thank you, June. So as Marc said, there is a subset of ESP-related proposal that relates specifically to governance or compensation. And this is a very interesting area of the shareholder proposal landscape, in my view. On the governance front, these proposals tend to be less about traditional structural governance issues, which June is going to talk about in a minute, things like special meetings and written consents, and tend to be more about whether the company has organized its governance in a way that promotes the ESP objectives of its investors. So the governance proposals that I'm alluding to tend to focus on things like board composition, including board diversity, which I'll talk about a little bit more in a minute, but also on things like director qualifications and whether the company is disclosing a skills matrix for directors, for example. One really interesting development in this last proxy season on this front was that we saw a number of proposals seeking employee representation at the board level, not always in the capacity of being directors, sometimes just seeking board observers or other types of representation. I think hearkening somewhat to the European model, where different works councils or labor organizations or even management teams sometimes have shadow boards or management boards. None of these proposals were adopted. In fact, they got quite low levels of support. But in view of some of the effects of COVID on employees and human capital and some of the issues that Marc just mentioned, we may see more sort of employee representation types of proposals next year. We also continue to see proposals seeking to link executive compensation, incentive compensation, to achievement on specified ESP metrics. For example, has the company achieved diversity-oriented metrics? If not, perhaps the executive comp plans should not provide for the payment of incentive compensation to managers. So we continue to see a little bit of that. And then, as promised, I just want to circle back to the issue of board diversity for a minute, because this is one that is linked between the shareholder proposal process as well as the legislative process. We do continue to see some shareholder proposals oriented towards enhancing diverse representation on boards of directors. But we did also see legislative activity in states like California seeking to impose diversity requirements on companies. And in the last year, I think the focus has really shifted from what had been an intense focus on gender diversity to more ethnic and racial diversity and other forms of diversity on boards. And we've also seen some activity from the proxy advisors and from some of the larger institutional investors pushing for more diversity on boards as well through their policies and public statements. As Marc mentioned, there is a cautionary note to all of this, which is that there has been some litigation challenging companies that have disclosed their diversity goals and their approach to diversity on the theory that their actual board composition or actual CC composition does not reflect achievement of those objectives. So with that, June, do you want to dig in a little bit more into governance now?
Yeah, sure. I think Melissa set this up perfectly because for those who've been tracking the area of shareholder proposals, specifically governance proposals, you've been seeing this toggle, this seesawing between the structural governance proposals, which really were the original governance proposals, but also kind of the original shareholder proposal topics. And by structural governance, we mean, proposals where shareholders are asking for expanded rights to participate in the governance of the company, such as the ability to act through written consent, to have the right to call special meetings, etc. That has been the bulk of the governance proposals for a really long time. And in recent years, we've seen a surge in the kind of ESP crossover topics that Melissa has talked about just now, as well as an emphasis on the independent chair proposals. And so last year, where we saw the combination of independent chair proposals and board composition proposals taking center stage in the realm of governance proposals, this year we saw a reversal once again. And this year, there were more shareholder proposals submitted on the topic of shareholder structural rights. So, for example, this year, the most prevalent topic was written consent proposals, which increased 61% year over year and represented 23% 20% of all governance-related submissions. So definitely an increase. The second area where we also saw a meaningful increase was in the area of special meeting rates, where proposals increased year over year by 1/3. This year, there was also, for the first time, a meaningful number of proposals from John Chevedden that requested shareholder approval of bylaw amendments that were unilaterally adopted by a board of directors. And in contrast, what we saw this year was a decrease year over year of 30% in proposals requiring that the chair of the board be an independent director. That is somewhat, that decrease is perhaps somewhat tied to the low support for those independent chair proposals last year. However, we're not sure that that trend in a decrease of independent chair proposals will continue, because this year the support both from shareholders and ISS meaningfully increased. So, who knows what happens next year. These numbers tend to toggle year over year based on the last year's results. And I'll just go quickly through the structural proposals that did and did not really take center stage this year. For example, written consent proposals were passed at a high level last year. 18.2% of proposals last year passed. This year, although ISS supported 77% of the proposals that went to a vote, the average support level continued to drop, and only 2 proposals passed, one narrowly and one at a higher rate. So the relatively low success rate of these proposals that we've been seeing since 2018 seems to continue to reinforce the idea that many shareholders don't think that additional written consent rights are necessary in light of the fact that many companies already provide for shareholders to act through special meetings. Once again, when we are talking about the shareholder proposals on special meetings, the bulk of them focus on lowering existing, not on adopting a new rate, because many companies have already adopted such bylaws. Instead, they focus on lowering the percentage for ownership for existing shareholders to call special meetings. And in many cases, the shareholder proponents are asking for 10 to 15% thresholds, whereas 25% has held steady as the common threshold for shareholder right to call a special meeting for a number of years. And even BlackRock recommends thresholds between 15 to 25%. All of that is to say, if you have a standard, even if you have a standard threshold at between 15 to 25%, you may not be immune to a shareholder proposal that asks for an even lower percentage. And then very, very quickly, I'll touch on some of the historical and high-passing types of shareholder proposals on structural governance, and they're eliminating supermajority thresholds, proxy access, declassifying the board, majority voting in uncontested elections. Elimination of supermajority, declassify the board, and majority voting proposals and provisions have been widely adopted, especially at S&P 500 companies. And more recently, proxy access has inched into that area as well. So not surprisingly, this year we continue to see a drop-off in the shareholder attention on those types of provisions.
Okay, so our next slide should be very interesting to anybody who deals with shareholder proposals, because this will give you a sense of which proponents are sometimes willing to withdraw their proposals if you engage with them. And there is a huge disparity in approaches, as you'll see here. For example, Arjuna Capital almost never withdraws proposals, whereas As You Sow is often willing to withdraw proposals. And the variance may be explained by the nature of the proposals that they're submitting. As I mentioned earlier, As You Sow submitted quite a few sort of SASB disclosure framework-oriented proposals in 2020, and a number of issuers were able to accommodate those requests by agreeing to add disclosure to their public filings or their website without the need to actually take those proposals to a vote. Whereas there may be other shareholder proposals that proponents are putting forward that are harder for issuers to accommodate just by adding additional disclosure, or that otherwise meet with more resistance from other investors in the issuer's shareholder base. The other comment that I would make on this slide is, of course, we continue to see that the vast majority of structural governance proposals continue to come from three proponents, Chevedden, Steiner, and McRitchie. And many of you who work with issuers will be familiar with those names and have probably seen their proposals come across your desks during the open window for shareholder proposals in the past. As I said, engagement can be helpful in leading to withdrawals, not always, but sometimes. And the outcome of that engagement is not uniform across issuers. Sometimes engagement is successful in generating a withdrawal just through promises of additional engagement and further discussion. In other cases, issuers have agreed that their board will study the proposal. In some cases, they agree to generate a report for the board, which may or may not become public subsequently. Sometimes they agree to enhance disclosure. So I think there continues to be a lot of variability in approaches and variability in issuer sensitivity to the different topics that are raised by shareholder proposals. So with that, I'll turn it back over to Marc to touch on Say on Pay.
As I predicted, we're not going to be able to hit a lot, not hit everything. So we're not going to discuss the no action process. There's really not that much news there, but it is outlined in our materials and in the back of these slides. I did get a question as to whether or not this presentation will be uploaded to our website, and I'm embarrassed to say I don't know the answer to that. But I will push for that, and if for some reason we don't do that, please just reach out to any of us, and we're obviously pleased to share it with you. But so if you have any other questions, this is the last couple of minutes, I think, for you to sort of queue them up, and we'll do our best, again, to deal with them. So if we look at slide 29, last year's Say on Pay season looks pretty routine. We have average levels of support that are consistent. Very few companies actually fail. We continue to have significant turnover, although a little less turnover than we had in those companies that failed year over year. And that turnover to me usually is just a sign of the metrics that investors use are just very endpoint sensitive. And so, if the endpoint changes, then the recommendation changes. And to the extent you have structural issues, it's fairly easy to identify changes to those that will help your vote in the following year. So I think our final slide that we'll talk about is slide 30, which has some more detail with respect to the vote. And then we're going to talk about 2021, because 2021, I think, is not going to look anything like 2020. So, in this context, I think that you can see one thing that holds pretty steady is ISS's against recommendations of being just a touch over 10%. Sometimes there's a little bit of noise in it, but that's a fairly steady number. And then you can see the effect of that recommendation as between the S&P 500 and the Russell 3000 generally. So I think if you look at the Russell 3000 number, if ISS is in favor, you're at 94%, and if ISS is against, you drop to 66%. So it's almost, not quite, a 30% drop, which is consistent year over year. But if you look at the S&P 500, you're looking at much closer to a 20%, a little more, 20% drop in 2020, which is, in this context, I think meaningfully different than the closer to 30% that happened in 2019. I got a question, which is, can we discuss any special rules for large institutional shareholders, noting that ISS and Glass Lewis aren't quite as relevant as they were, and noting that CalPERS potentially has a new model that's being driven by Equilar, and that may result in more withholds. I do think that you are seeing I do think that you're seeing a continuing disconnect between ISS and some of the larger institutional investors. Usually, I believe that to be more consistent with the numbers that are reflected in the S&P 500 column here, which is to say that many larger institutional investors, I believe, use ISS as a screen, which is to say, if ISS says you're okay, then I'm not going to spend that much time looking at you. If ISS finds an issue, then I'm going to dig deeper, and I may or may not coincide with ISS. I think the instinct to dig deeper plus the willingness to engage are probably what sits between the 30% gap if you're a smaller issuer and the 20% gap that if you're a larger issuer, there you get more attention, is my impression, and you can actually talk to folks. Whether or not CalPERS adoption of a new model, we know Equilar was looking for someone to use that model. Whether that causes more against recommendations, I just don't know the answer to that. I don't know how significant that is to issuers. One thing I do know is that this is a weird season. So there are very few issuers, particularly calendar year filers, whose annual program, unless it's fully discretionary, is functional this year. And we have seen ISS note that they think they're going to recognize that. But I just, whether or not they do, I think you're going to be in very substantial company if you needed to either modify your program already, or modifying it on the fly, or you're modifying it after year end. And that would typically be a no-no for most big institutions and for the advisors. And I think you're not going to have exactly that reaction. There may be some. Otherwise, this percentage against is going to go way up, which is, that's why I made the point about it being pretty steady. And I have heard that ISS has been, just recently has been discussing this. It's obviously on their agenda for policy making. I think that we're going to hear from them relatively soon. And I think, there is obviously the annual program, which I've talked about, but there is also the long-term program. And like many things that this pandemic has touched, it has wrecked many of what I would call rigorous long-term programs. And I know many issuers who are struggling with when to fix it and how to fix it. And from that perspective, my bet is that the articulated policies are not going to be as forgiving as they would be for the annual. But you may just have to do it. And from that regard, if your long-term is an equity plan, you should keep in mind that if you modify it before year end, that modification will be reflected in this year's proxy, in this year's 2020 line item, which you could then label with a big fat pandemic sign on it. If you modify it when you're usually thinking about, year-end comp, which is February, March, then it will appear in 2021. Now, you may have more insight as to what folks have done at that point, but you might not, depending on when when your peers actually file their proxies. That's it. It is noon, at least here in New York, and I think we've answered all the questions. We will work to put the slides up. I did have one question, which was, have we observed a trend among investors to decline issuer outreach calls? And the answer is, I have not observed that trend. Sometimes that's a sign that they're too busy and you're not big enough. Often that's a sign that you're not on their radar screen as a troublemaker right now, and therefore there's not much for them to talk to you about. I don't know which way to take it, but I've not observed a trend in that area. I think June promised that we might reissue the code, and so I'll defer to her on that.
Yep. Once again, the code is 981235. 981235.
Thank you all for joining us.
Yeah.
We have this and much more available on our websites and our regular publications, which I'm sure will soon include a more detailed version of the SEC meeting, which also adopted whistleblower reform, just for sake of completeness, sometime later this week. Wish you good luck in the season.
Bye-bye.